Okay. Welcome back. All right. So the last session in book 5, in book 3 is session 5. Session 5 is about budgets and the budgeting process. Budgets and the budgeting process. Have you ever heard about the word budget? Okay. Do you know what we mean by the word budget? What does it mean?
Money. What the business have.
Okay. What the business has already?
Budget. Yeah.
Or something, or you try to plan for the future?
In my experience, no. They have already.
You have already?
Budget, yeah.
Okay.
Yeah.
All right, let's see. Let's read the aims first, and then go through what we mean by the word budget.
Okay.
Okay. Aims and objectives of this session is to describe what budgeting is and why it is important for businesses. Okay? Outline how the budgeting is, why it is important for, outline how the budgeting is and why it is important for businesses. This is the first objective. Then outline how the budgeting process works. Okay? Look at different types of cost and how they behave in relation to changes in the level of business activities. And finally, to consider the behavioral implications of budgeting. Okay? All right. Let's see. Budget is a financial plan. It's a plan. And usually when you plan for the future. What should I earn in the future? Okay? How should I spend in the future? Okay? So it is a financial plan. It is a financial plan. Okay. And it can be seen as a statement of the financial effects expected from the resource conversion process that the business has planned. We plan to manufacture 100 units of this and to sell 8 units of this and so on. And we'll spend this amount of money. So we expect our budgeted profit, our budgeted net profit next year will be this amount. Okay? Okay? And companies or businesses prepare budgeted income statements.
Okay.
All right? Okay? All right, very good. Okay, so let's take an example away from business. Okay? Well, Dawood, assume that you are getting married. Inshallah. Congratulations. Okay. All right. And now you prepare your budget.
For my life.
Yeah, for your life. Okay. So you will go in honeymoon and come back. You prepare your budget before going for this, and you want to know because you plan for your life, right? Okay. Your salary is, assume 5,000.
Okay.
All right?
Okay.
Happy?
Good. Fine.
Okay, per month. All right?
Okay.
Let's talk about it at this level as per month, a monthly budget.
Okay.
All right? So you prepare, your salary is 5,000, and you will start to prepare to list the items that you have to spend in food, for example.
Okay.
How much food per month? You and your wife.
Yeah, my wife?
Yeah. You would like to eat alone or what?
1,000, no, 2,000 maybe. No,
2,000.
2,000, yeah.
2,000.
Yeah.
Okay. All right, 2,000.
Okay.
This is the budgeted.
Okay.
By the way, okay. The budgeted column.
Okay.
All right. So here we have the salary. Here we have the expense items. So the food. What else?
Rent.
Rent. How much?
1,200.
1,200?
Yeah.
Okay. 1,200. Some
electricity.
Bills, all the bills, like telephone, electricity, and all these things. Huh?
Say 1,000 كمان. لا.
Some another 1,000. Okay, these are 4,200.
Okay.
Am I right?
Exactly.
Okay. Anything else? Okay.
No.
I can just let's put like 400 just in case.
Yeah.
Just in case. Okay.
Yeah.
So here for emergencies.
Yeah.
Let's say 400. Okay. How much? So 2,000, 4,000, 4,600, right? So you expect to have some savings, surplus.
Yeah.
Of how much?
4,600. 400.
400 surplus. Good, not bad. Okay, all right. Now you are done with your budget and you are happy. You went through your honeymoon and everything is okay, and now you came back. Okay, starting your life. All right. So you started your life, and here is the actual column. The actual, what happened actually, okay? Do you think that there will be a change in your salary?
No.
The salary is known, except if you, la qadra Allah, got a penalty,
No,
or you got a reward, promotion, and you got a reward, okay? Let's assume it's the same, okay?
Okay.
So it's 5,000. And here is the column of variance. Is there any variance between the budgeted and the actual?
No.
No, it's the same. So no variance here. Food. Okay. For food, now, because your families were missing you very much, your family and your bride's family, so they decided to come and join you, okay, for 2 weeks. They are staying with you for 2 weeks, okay, and accordingly you will have to pay extra money for food.
Yeah.
So instead of paying 2,000,
3,000.
the actual came
2,500 maybe, or 3,000.
two families.
2 families? 3,000.
Okay, now we have a variance, right?
Yeah.
Okay, how much variance?
1,000.
1,000. Okay, $1,000 or Egyptian pounds, whatever. Okay, so this favorable variance or unfavorable variance? Unfavorable variance because you pay more. You know, in your salary, if you got a reward, this is a favorable variance. But here in this case, it's unfavorable. You are paying a lot. Okay, so this is unfavorable variance. Rent, do you think that there will be nothing? Okay, so it's the same. Excellent. No variance. Bills. Because your bride, yes, you leave her alone the whole day. You are working, okay, to get your salary, and she feels alone. What should she do? She just turned everything on, the TV, the radio, and everything. And she calls her mom every now and then not to feel lonely and so on. Okay, so instead of getting bills of 1,000 Egyptian pounds, you got bills of
1,800.
Okay, so it's now 1,800, you said?
Yeah.
800? Okay, 1,800. It's up to you.
That's what will happen.
Favorable variance or unfavorable variance? Unfavorable. Of how much? Of 800. Oh. What's going on here? 3 plus 2, 5. You are exceeding the 5,000.
I know. I still have emergencies and
nothing for emergencies, nothing for contingency. Nothing. Now you are in deficit. You need money. Where did you get this money from? From your mom, perhaps. Okay. Which means that, okay, here at the end, it's like 3 plus 1, it's 4, then 5, it's like 6,000. Oh.
I need to work more shifts.
Like you have $1,000 deficit. 1,000 Egyptian pound deficit.
I need to more work.
Will your mom lend you money or no?
Yeah, she'll help me, of course.
She will do that with interest or? Okay. What do you think about this budget?
No.
Do you think that we can manage our businesses this way?
No.
Of course not.
Wrong.
But do you think that budgets are important?
It is.
They are very important. Why?
To settle your life.
Yes. You know what? When you prepare your budget, you just keep your eye and keep focus on the budget you prepare. And every time you feel that you are spending a lot more than you have to, then you will, you will stop. You will stop doing this. And you will try to achieve the target at the end, to get surplus of 400 Egyptian pounds, for example, at the end. Okay? All right. Which means that this budget, this is an extreme family budget. So forget about this. Okay? But now you can imagine why businesses prepare budgets. It's very important. They prepare budgets, they try to forecast the revenues that they will achieve. They try to expect or forecast the expenses that they will incur. And at the end of the year, if they achieve budgeted profit or budgeted loss. You got that? So this is how they do it. All right. Here we have different types of costs and their impact on budgets. Different types of costs and their impact on budgets. Costs can be split into different types to reflect the way they arise. Each cost arises from a specific source or because of one reason or another. So the different types of costs need different budget treatment. Each type of cost needs different budget treatment. Let's take this. Here we have, this is the type of the costs. We have fixed costs, variable, discretionary, and contingency. Okay? All right. Do you know what we mean by fixed costs? Fixed costs? Okay. Fixed costs, these are the costs that will remain fixed regardless of the volume of the activity. Okay? For example, if the activity that we are talking about is the level of production, the fixed cost will be fixed regardless of the number of units produced. For example, the rent of the factory. Will the rent of the factory be affected by the number of units produced? No. You will pay the rent anyway. If you produced, you will pay the rent. If you did not produce, you will pay the rent, right? If you produced 1,000 units, you will pay the rent. If you produced 1 unit, you will be paying the rent, right? So it's a fixed cost. But generally speaking, fixed costs are fixed, but within a specific range, okay? So you will know about that in cost accounting course when you study cost accounting. But for the time being, you should know what we mean by fixed costs. So fixed costs, these are costs that do not vary in relation to the chosen measure of activity. They do not vary according to the chosen measure of activity, as the example I gave to you now. Some examples of this, these are staff costs, rent payments, and so on. Okay, flexibility. Are they flexible? Now, while you are preparing your budget, can you cut such costs down?
Yeah.
They are not that flexible because you have to pay the rent of the apartment. Yes, you have to pay your staff, right? So sometimes it's very difficult.
I'm talking about like the food and I can cut from there.
You can cut from some other, you can be more creative or innovative and produce with lower costs sometimes, and so on. You can cut from the contingency item, or cut from the discretionary. Let's see the flexibility level in each. So here, not very easy to cut down on fixed costs because they are time and activity related. Okay, we can't. If you need 10 employees to do this process or this operation at work, you will never be able to fire any of them, and accordingly you have to pay their salary, right? Okay, and the rent as well. Except if you change it, the place that you rent for lower rent, okay? Variable costs, these are costs that vary in relation to a chosen measure of activity. For example, the raw materials, the cost of raw material in relation to the number of units produced. The larger the number of units you produce, the higher the costs, the raw material costs, because, right? Because every time, for every single unit, you need raw materials, which means that in general, the larger the number of units you produce, the higher the variable costs of raw materials, or the cost of raw materials. Example, electricity costs, telephone costs, cost of maintaining inventory, raw materials costs, as I told you, if we talk about the production volume. Here we have flexibility level. Organizations can attempt to cut down on variable costs through what? Through the efficient use of resources and through sustainability. Now, would you like to cut in variable costs in your budget? Cut them down? You need to be more efficient then. Yes, you need to be more efficient. It's not about cutting only. You need to be more efficient to do the things right, to do things right, the right way. So you can, when we talk about efficiency, to do the activity, to conduct the operation, to produce or whatever, with the lowest possible cost, okay? And this happens when you have to check your machinery. Are they obsolete? You have to check the quality of the raw materials. You have to check the qualifications of workers, and so on, based on the type of the process that you try to be more efficient in, and so on. This is the only way through which you can cut such costs, okay? All right, discretionary costs. These are costs that are independent of the volume of activity, like fixed costs, but are not yet committed. They don't have anything to do with the level of activity, like they don't have anything to do with the production volume, for example, but still they are not committed. Why? They are non-urgent, like maintenance, okay? Research and development costs, all these things. So you allocate some money in the budget for such items, okay? But you allocate some money for maintenance. You have to do the maintenance during the next year, but still you did not do it, right? Okay? So we call it discretionary. Okay? These are the easiest budgets to change. The easiest. If there is pressure to cut down on budget, it is simpler to cut down on non-urgent maintenance, research and development, and so on. These are, okay, we are in need for money and we need to cut costs down. So let's, okay, we conduct maintenance every year. Let's postpone the maintenance for this year to the next year, okay? And so on. So this is what we mean by discretionary costs. Contingency, these are costs related to special occasional events and contingencies, like emergencies, okay? For example, terrorist attack. We had a problem, we had earthquake, we had a terrorist attack, something like this. So you have to allocate some money in your budget to face such events. Like emergencies. Contingency costs are problematic because you hope that the event does not occur, we hope so, and it is unlikely to in any 1 year. It is unlikely to occur, but still you have to allocate some money just in case. For this reason, companies or businesses pay for insurance, right? Okay, and so on. So these are different types of costs that affect, yes, they have effects on budgets, and they have different level of flexibility when businesses prepare their budgets. Some items they can cut down, cut costs down in, some items are not. It's difficult, okay? Finally, in this session, we have what is called behavioral consequences of budgets. Behavioral consequences. When, at the beginning of the session, we said that it is very important to Well, it is very important to have budgets, and we said that budgets actually motivate people to meet some targets, right? And to conduct what we call the control, okay? It's very important for control procedures, because usually top management will compare between the budgeted and the actual at different point of time during the year. So that if they feel that one of the managers is spending a lot and not complying with the budget, they will just give him the negative feedback saying that, okay, stop doing what you're doing, okay? Or one of them is doing very well and either he is on the right track or she is on the right track, so they will support him, okay, you are on the right track, go ahead. If there is a problem, there is a difference or variance between the actual and the budget, this will encourage management to analyze what's going on, okay? So that they can avoid any like negative consequences at the end of the year. They do not wait until the end of the year. So this is one of the main aspects. One of the purposes of budgets is to motivate people. You need to motivate people through having budgets by giving targets to work towards, okay? And against which they will be evaluated. Everybody will be evaluated against this. Did you achieve the budgeted result, okay? But actually, budgets can also have demotivating effects when you set them unrealistic. When, for example, okay, I prepare a plan with you to study the B120 3 books within 3 days. Is this realistic? No. It's not. Which will, at the end of the 3 days, you will feel demotivated because you were not able to meet. Yes, to meet the plan, right? The same for budgets. When we prepare budgets, we need to be more realistic. We need to not to push our employees. Yes. So this way, just try to get motivating budgets and instead of getting demotivating budgets. Okay. So these are the main two behavioral consequences of budgets. Okay. Now we understand what we mean by budgets. In your book, you have an example of a budget in which they show you the cash in, the cash out. Okay, it's about travel agency. Okay, and it's a 12 months budget showing all the fees she gets in her agency, cash in. Okay, every month, and the cash out, all the expenses she incur. All right, and at the end of the month of each month, she achieves surplus or deficit, and so on. Okay, you can just check this. This is very important example, just to be more familiar with what we mean by budgets. Okay, all right. Any questions? This way we are done with book 5. Sorry, with book 3. Okay, this way we are done with book 3. So, do you have any questions so far? Okay. So today we finished sessions 3, 4, and 5. Session 3 was about accounting statements, income statement, balance sheet, and the statement of cash flow. Session 4, we have only section 4.4 of this session. Difference between management accounting and financial accounting. Excellent. And finally, the session 5, which is about budgets and budgetary control. Okay? All right. Any questions?
About budgets.
About budgets?
Yeah, the exam. How do you ask me?
Define budgets. Define budgets. Explain the behavioral consequences of budgets. Explain different types of costs that affect budgets. Different types of costs that affect budgets. This way. Any more questions?
No, thank you.
Okay. Thank you very much. And see you next class.